Test 1 2 3. Test 1 2 3. What's up? So let's imagine a scenario where there's a brokerage account, and inside that brokerage account there's three stocks: Google worth $1,200, Apple worth $200, and Coke worth $50. So the total aggregate assets are about $1,450. Now let's also imagine that there's a credit card balance owed against that brokerage account of $450. So the net residual asset value is about $1,000. Now, for illustrative purposes, let's assume and pretend that that brokerage account is up for sale for you for $375. Interesting idea, right? Or interesting opportunity, at least. Is it a good buy? Is it a good investment? Is it undervalued, overvalued? What would you do? Well, if you kind of work through that math, if you have something that's worth $1,000 and you can buy it for $375, well, that's kind of like buying $1 for about 37 cents. Pretty good investment. Because otherwise if you did go ahead with that transaction, you would profit with $625 straight into your pocket. In other words, you'd make about 167%. Why do I bring up this scenario? Well, I think the reason is because I have this company in my sights called NL Industries, ticker symbol NL, that I want to discuss with you guys today. It's not a FANG, it's not a unicorn, it's not a stock that's really on anyone's radar. It's never discussed on CNBC. And so I kind of wanted to dissect this particular company because this example, I think, mirrors what's going on with this company. So let's go ahead and let's talk about that. NL Industries is a holding company, and it's comprised of three assets, which also happen to be publicly traded. The largest, most important asset is going to be a global titanium dioxide producer called Kronos Worldwide Inc., ticker symbol KRO. NL's interest in that business is worth approximately $505 million. Now, the second asset is going to be a security and marine components manufacturer called CompX International. NL's interest in that business is worth roughly about $165 million. And then lastly, NL also holds an interest in a company called Vahli Inc., ticker symbol VHI. And that value is about $37 million from NL's standpoint. Now, if you aggregate all of those assets together, that investment portfolio is worth about $707 million. Now, add back cash, and you have about $71 million, and you have an asset value that's about $778 million. Now, if you subtract out all of the liabilities associated with NL, just like the illustration that I had walked through with you at the beginning of this episode, well, take out debts, take out underfunded pension liability, accrued environmental costs, and litigation liability, they all amount to, in my very conservative estimation, of about $283 million. So you stripped all those out, and you have a net residual or a net asset value of about $495 million as of the date of this recording. Now, that value compares with NL's market capitalization of $190 million. On a per share basis, that implies NL's net asset value is about $10.34 versus the share price of $3.90 as of the most recent close. That implies an upside potential of about 165%. Again, 165% return potential. Pretty interesting, isn't it? I mean, like I said at the beginning of the episode, that's kind of like buying $1 for 37 cents. Why wouldn't you want to do that? It makes all the sense in the world. I mean, who wouldn't want free money, essentially, right? I mean, it's an amazing return. Don't you want to buy it? I mean, don't you want to call your broker right now and give him a phone call? I mean, open up TD Ameritrade, open up Charles Schwab. Go ahead, look at the ticker symbol, NL. Go ahead and take a look at it. Wait, so hold on. Before you do anything crazy, hold on. Don't fall sway to the Jedi mind trick of framing. And now that's kind of exactly what I just did. I laid out the investment prospects, all of the possible gains associated with this investment opportunity. I didn't lay out any of the inherent risks or some of the underlying assumptions that gets you to that $495 million net asset value or the $10.34 per share. So framing, for those of you who aren't really all that familiar with that term, it's a cognitive bias that was popularized as one of the cognitive biases that was popularized by two psychologists during the 1970s, Amos Tversky and Daniel Kahneman. And they kind of are the forerunners or the frontrunners behind the whole phenomenon around behavioral economics. And so framing is essentially packaging information in such a manner that will influence your behavior or the conclusions that you will extrapolate based on the limited information that I provide you with, or the tailored information that I provide you with. So the reason why I bring that up is because there, for so many of us who consume a lot of investment content, a lot of the stuff out there has been framed for us to look at a stock or an investment opportunity in a particular light and then to draw a logical conclusion based on the limited information provided to us. So that's why it's so important for you to do your own research, and that's why I'm trying to pivot this conversation away from saying, hey, look at this great return potential, the next logical move is you should buy it. Instead of that, look at it, and then that should incite you to go and do your own research instead of thinking, oh, there's a great investment opportunity, I'm going to just buy it just because of what I just saw or heard. So I just wanted to throw that in there really quick. That's really important, and I hope you don't get duped based on whatever get-rich-quick schemes there may be out there, especially on YouTube. So moving on to the background story for NL Industries. So part of the reason for the valuation disconnect in NL has a lot to do with its questionable past involving a number of ongoing lawsuits related to various chemicals and waste contamination. And so one thing to keep note of regarding NL is that it's actually an old industrial company founded in 1891 in the state of New Jersey, which, eventually it's evolved from what it once was into what it is today as a holding company. But in the past, it was actually involved with a number of different business activities, including the production of lead-based paints, the operation of lead smelters, the manufacturing of various lubricants and machine equipment for the oil industry, and even in weapons manufacturing. Now, while the company is no longer involved with producing lead-based paints, as those operations were shut down in 1974, NL has been a party to an ongoing lawsuit involving contaminated sites throughout the United States. So, for example, relatively recently, NL was convicted and held liable for about $1.15 billion in damages alongside the Sherwin-Williams Company and ConAgra as they were linked to the sale of lead-based paints here decades ago, prior to the United States ban in 1978. Now, while those three companies reportedly weren't aware of the hazards and the risks associated with lead-based paints at the time, they were nonetheless held liable in the state of California in January 2014. Almost immediately, NL pretty much suspended its 50 cents per share dividend at that time, following that announcement in February 2014, and has never resumed dividends since. Now, subsequently, though, in roughly around September 2018, the California court system did truncate or shrink the size of that $1.15 billion liability down to $409 million, which was a significant reduction, largely due to the fact that those three companies are no longer going to be held liable for damages or the usage of lead-based paints In homes, all the way up until 1980, they're going to be liable up for homes that have utilized or have been exposed to these lead-based paints up to 1951, I believe. And so that's caused a pretty significant reduction in that liability to $409 million. Nevertheless, the reason why I'm kind of walking through this example is largely to highlight just how serious and just how what magnitude NL is exposed in terms of these environmental costs and litigation risks. And so, aggregately speaking, the company's environmental costs and liability, contingent liabilities or litigation liabilities, they can range anywhere between 163 million, which is displayed on the balance sheet, up to, in my estimation, of approximately 274 million. So how do you get to that upper range valuation in terms of the liability risks? Well, I think there are two major swing factors. One of them includes accrued environmental costs. So over the last decade, the company has continued to revise environmental costs upwards almost consistently every year. And so while they're displaying, I believe, accrued environmental costs of roughly approximately $98 million on their balance sheet as of the most recent 10K, I think it could go and will likely continue to march upwards from there. In addition to that, the company is realizing roughly about $65 million in net litigation liabilities associated with that $409 million lawsuit. But if you were to just kind of cut that $409 million into thirds, so 1/3 to NL, 1/3 to Sherwin-Williams Company, and 1/3 to ConAgra, NL is more likely, their litigation liability is more likely closer to $136 million. So I'm embedding that into the $274 million total or sum. I think NL is ultimately a cost or liability containment vehicle, which the ultimate parent company, Contran Corporation, which owns a majority interest in Vahli Inc., which in turn owns a majority interest in NL Industries, set up as a risk mitigation measure. I can see a scenario where management deposited these three core assets into NL Industries with the intent of either, or at least in part or in whole, liquidating these assets to meet these incredibly long-tailed environmental liabilities. And management, they never really knew how large or when these liabilities would become made manifest. And so I could see how they had an enormous incentive to be able to localize within NL and to confine within NL the possible liabilities that will arise associated with these environmental concerns. Now, with that being said, if you were to kind of arrive at a relatively conservative liability range on their accrued environmental costs and their litigation liabilities, it would seem that NL is trading at a substantial discount to the net asset value, or the NAV, of the business. Again, the NAV is $495 million versus the market capitalization of $190 million. Now, one other thing that you need to consider is that after the company discontinued or suspended its 50 cents per share dividend starting in early 2014, the company has traded at a 40% discount to NAV over the last 5 years. Now, if you were to apply that 40% discount moving forward, you're still going to look at an intrinsic value per share of NL of about $6.20 per share. That compares with NL's per share price as of the date of this recording of $3.90. That, in other words, that looks like you have about 60% upside to current price levels. So that is somewhat interesting to consider. Now, practically speaking, if you're a value investor managing a relatively diversified portfolio, when I mean diversified, 20 plus positions in your portfolio, I think NL kind of could fit within the possible opportunities that you could invest into. I think that it's something that you could realistically consider. But if you're a value investor managing a very concentrated portfolio of somewhere between 6 to 8 stocks, I think you should just move on. There aren't any catalysts that are on the horizon that could close the valuation disconnect, and so there are better fish out there to go after. Now, if you're insistent on looking at this opportunity, and you want to do something sexy like a pair trade where you long NL shares while simultaneously shorting KRO shares. As a retail investor, I don't think that's a really prudent thing to do, largely because shorting for the retail investor is just so crazy expensive. And so those are just some 3 key practical takeaways. Okay, so moving on to the risks associated with this company, I think there are going to be 4 that really come top of mind. And the first and probably the most important one is going to be Kronos Worldwide Inc, because it's the most vital asset of NL. If the titanium dioxide industry undergoes a cyclical downturn, you could reasonably expect that KRO's valuation is going to decline, which in turn should negatively impact NL's NAV calculation. Moving on, if NL's management team severely miscalculated its accrued environmental costs, that could negatively impact NL's intrinsic value as well. And then regarding the $409 million litigation liability associated with the state of California, there hasn't really been any really concrete disclosure around what amount exactly NL is going to be responsible for. NL on its balance sheet indicates that on a net basis, they're going to try to sell for about $65 million, but that's still in process and it's not definitive as of yet. If you were to just cut $409 million into thirds, right, between NL, ConAgra, and the Sherwin-Williams Company, that liability all of a sudden becomes $136 million. Now, we don't know if that's too much, too little. If it's more than $136 million, then NL's NAV calculation goes lower from my estimation. And then finally, because the state of California has been successful in being able to win the court case regarding lead-based paints, the sale of lead-based paints decades ago, Pennsylvania is also following suit. However, just a little caveat, the extent of damages that the state of Pennsylvania is looking to claim is actually far smaller than the state of California, based on my research, and more parties appear to be involved than just simply 3 companies. So arguably that's a lesser concern or a lesser risk than the initial 3 that I just mentioned. So there are more risks you can find in the 10K, but I think based on my own research, these appear to be the 4 most important ones to think about, or at least the 4 most apparent ones to be thinking about. So, that's kind of in a nutshell the thesis and the risk around NL Industries. And so I did attach a financial model, and my notes in the description section for you. So you can, it's free. You can take a look at that and tinker with the model and take a look at some of the assumptions there. So with that, if you found this episode to be interesting, something that along the way, maybe you learned something new, I'd really appreciate it if you hit the subscribe button, give us a like, leave us some comments. This content is also available on podcast, where we're also called Get That Bread Value Investing. You can find similar content there. So with that, I guess I'll see you guys in the next episode. Later.